Welcome to this third tutorial video about RealTest. In this video we're going to develop a new strategy and take a look at the inner workings of RealTest's backtest engine. So let's get started by altering this simple script that we had in one of our previous videos. This imports data from Yahoo, but instead of importing just one symbol as here, the SBY ETF, we're going to actually change it and we're going to ask it to go and import a whole list of symbols from a text file. And that's in our examples directory and it's called spx sims.txt. As we're only testing from 2010, we might as well only import data from 2010. So we're going to start at 2010. I'm going to give this a different name. So I'm going to call this Yahoo SPX, and obviously it's really important that I also use the same data file that I'm importing in the test settings. So let's put that in here, and now I can run the import. So it should be fairly quick as it goes off and connects to Yahoo and produces that data file that we're going to use for our strategy. The next section we need to take a look at is the strategy section itself, and we had been using a moving average crossover, but we're going to be creating a breakout strategy. So I'm just going to call this breakout, and instead of having a crossover of moving averages, I'm going to have an entry requirement that the close of the last bar is greater than the highest value of the close over the last 20 bars. But if I just left it like that, we're never going to get any entries, and that's because this highest close of the last 20 bars includes the bar that we're comparing with. So close will never be higher than the highest of the bars it's included in. So we need to say go back one bar, and we do that by using the square brackets 1. So this is saying if the close is greater than the highest close in the last 20 bars starting from the bar before this one, then we're going to enter. And likewise, we're going to have a breakdown condition for the exit rule, which is that close is less than the lowest of the close over the last 20 bars. And again, we need to compare it with the previous bar, otherwise it will never exit. So let's run this test and see what the results are like. We click the test button, and in a matter of seconds, we get slightly crazy result. So this is -1 with 15 zeros after it, and this is a very large maximum drawdown. In order to understand what's going on here, we really need to look at how backtesting software works in general. Most backtesting software works with just one strategy at a time. So you would load the code that you've written for strategy A. The backtesting software would then load all the data it has for the various stocks you're going to test, and it would have a series of data that it's going to work through to produce a series of results. So it starts with the code from the strategy. It takes the first stock, it then examines that on January the 1st, the first date, and it then runs the strategy, says are there any entries, are there any exits, produces results, and then moves to January the 2nd and the same, and carries on all the way through the dates for that one stock in isolation. Having completed that stock, it then moves to the second stock in the list and starts at January the 1st, and the whole process begins again. The problem, of course, with this process is that it doesn't actually take into account whether you've got enough equity to buy these different stocks. Each one is being examined in complete isolation, and that's before we even start talking about having multiple strategies running at the same time. At the end of this process of going through strategy A individually on each stock, it then has to do a second pass to combine all the data, and at that point it's trying to guess, given the individual tests it's done, which positions would have been entered or exited and so on. And it's really something that's been bolted onto the original software. It's not well thought out. Contrast that with how RealTest works. So in RealTest the process is reversed. We start with a series of dates and we go through it as if we're actually trading. And then we have a series of strategies which can all be active at the same time and are gone through in sequence. And finally, we have our list of stocks that are loaded in through the data that we've been loading in the RTD file. So we start on January the 1st and we examine strategy A. And with strategy A, we look at the first stock. We actually take out any stocks, first of all, that don't have any data in the particular date. And then the system, RealTest, takes a look at this stock, says are there any entries, and it adds those into its list of entries or exits and stats and equity. Of course, for exits, it doesn't need to go through the whole list of stocks. It can just use a list of the positions that it currently has, and then that's much shorter and much quicker. Once it's gone through all the individual stocks for strategy A on January the 1st, it then moves to strategy B and says, have we got any entries or exits for the first stock, and it makes a note of those, and so on. The big advantage of doing it this way is that RealTest is keeping track of the trading as if we were doing it in real time. So what's happening here is that we are actually conscious of how much equity we've got, of which positions we've got open, of which positions are closing, and so on. So RealTest then repeats this entire process which it has done for strategy A. It does the same one with strategy B, the same process for strategy C, and the same process for strategy D. And you can have many, many strategies that are all working through things on the same date, looking at the range of stocks that they could enter or exit. RealTest actually does this 3 times. So the first time it goes through all the strategies looking for entries or exits in each of the stocks, it does at the open. That's the price that we know that each stock opened at on that particular day, and so we can check to see whether there are any exits and whether there are any entries. Then if there is still room for extra entries and exits, it redoes the whole process again for intraday. So it looks at the high of the bar and the low of the bar to see whether any of the triggers, limit orders for example, are actually triggered into positions during the mid part of the day. And then finally the process is repeated for the close. So let's take a look at what that would look like on an actual stock chart. Here we've got Apple, the chart of Apple, and we're going to see how those 3 passes would happen on a particular bar. So the bar we're going to examine, the execution bar, is this one on June the 8th. Of course, this is the bar that we're about to trade. It's not the bar that we have data for because it hasn't happened yet. So the bar before it is called the signal bar, and that's the one where we actually have the figures for open, high, low and close, and that's what we'll be using for our calculations. Let's expand this execution bar to take a look at where RealTest is going to do those entries and exits. So here it is larger, placed higher up. First of all, it will look at the open of the bar, and it will go through all of the stocks looking for first strategy A and then strategy B and so on. It'll start with any exits that need to happen, because when you exit a position at the open it frees up capital which can then be used for entries. So that's just like in real trading, if we had an exit that happened at the open we'd be able to make an immediate quick entry into a new position. Having done that, it looks at the high and the low of the bar, which is the intraday entries and exits, and it does them in the opposite order. And the reason is that we don't know whether the high occurred before the low or the other way around. And so RealTest is conservative. It will take some new entries if there's available capital, but it will then process exits afterwards because we don't know if capital was freed up for new entries at which point of the day that happened. And then finally, the third pass happens at the close. And again, it will look at exits first because they free up capital for entries. In practice, this would probably be done a few seconds just before the close when the prices are pretty much at the close price so that you could take new positions for the next day. The types of entries and exits that happen at these times are different depending on the time of day. So if you are putting an order in at the open, that will be a market order, that will be at the actual open price, and the same would be true of the close, which will be at the actual close price. Market orders at the close we're going to grey out here because they are not switched on by default, and we'll talk about that a little bit later on. If you place a limit order, however, then that could either happen at the open or during the day. It could happen at the open if there is a gap up or a gap down and you've placed a limit or a stop that gets hit, in which case it will execute at the actual open price, or it will happen during the day, in which case it's going to execute at the price that that limit or stop is set at, and that will depend on whether that falls within the range of the high and the low. So with that knowledge, let's take a look at our slightly crazy results. Let's right click this line and take a look at showing the trade list. And we can see immediately that RealTest's default account size of $100,000, which is here, is being invested fully into each position it takes. We've got very large numbers of shares being entered into, sometimes up into the 10,000s, even 91,000 here, and huge swings in profit, and in this case large losses, 173,000 loss when we've only got an account size of 100,000. So it's clear that what's happening is that a very large number of shares are being entered, and they're being entered into in a very large position size, which is not what we wanted at all. And that's because This script, unlike our first script in previous videos, has lots and lots of symbols that it could enter, up to 500 symbols from the S&P 500, and we need to actually tell it exactly what we want to do with these entry setups. So we're going to add some extra lines here. The first one we're going to add is just a good one to have generally, which is to tell it that we're entering on the long side. We're buying shares, not selling them. The opposite would be short. And we are going to now also enter the quantity. So we're going to be putting a maximum quantity of 10. Now, if I just leave it as 10, that will just mean that we buy 10 shares for each particular entry. But of course, that's not an equal weighting. Some shares might cost thousands of dollars each, some might be less than $1. So we actually want to make sure that that is specified correctly. And I'm going to use quantity type to tell it that this is a percentage. And that means that each position that's entered is going to be 10% of our equity, which starts at $100,000. That, of course, could still allow us to overinvest our account. If we've got 10% in each position and potentially 500 stocks that were all trending up at the same time, we could be very heavily into margin and could cause a lot of problems on the account. So the final item that I'm going to add is a maximum positions, and we're going to limit our maximum number of positions to 10. So we can buy up to 10 positions, each of which is 10% of the account. And now if we rerun this test, we'll find that the results are much more sensible. We've got a rate of return, an annual rate of return of 18% and a maximum drawdown of -31. If we double click that, we can see we get a not too bad equity chart for such a very simple system. And as before, we can right click and show the trade list, and we can see what's going on. Now these are listed in order of exit, so you'll see that the date out starts on the 26th of February and it goes up, and our first 10 positions that we entered, this one here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, those are our positions that we entered at first, and we're holding them for quite a large number of bars at first. So we've got those of us our first 10 positions. If we look at the symbols that have been entered, you'll note that they are all in the start of the alphabet, and we need to take a look at why that is next. So if you remember, this is how RealTest does its backtesting. It starts on the first day, in this case January the 1st, looks at strategy A, in this case we've only got one strategy, and it starts at the top of the stock list, which is by default alphabetical, and says, are there any entries or exits for this particular stock? And because in this case we specified a maximum number of positions of 10, if it finds 10 entries at the start of the alphabet, then it can't fill any more positions. You may have a way that you actually want to trade which ranks stocks and tells it which ones to prioritize. For example, this is a different ordering, and you can do that in RealTest by specifying what's called an entry score. An entry score is just a numerical value assigned to each stock, and it ranks from the highest at the top down to the lowest entry score. If you've got an entry score defined, then strategy A will start with the stock or the ETF that has the highest entry score, see if there's any entries or exits, so in this case SLV, and then move on to the next one, XLE, and so on down the list. And so you can use entry score to rank which are the most important stocks to prioritize for entries. So now let's add an entry score to our script and see what happens. So I go into our script here, and on a new line I'm going to add entry score, and I'm going to rank the stocks by the percentage change of the close of the stock over the last 100 bars. So what that's going to do is any stock that has had a very high percentage change over the past 100 bars is going to get prioritized in our 10 slots that we can fill for entries. And when I do that, I find when I run the test again that it does in fact improve results. We've now got a return of 23% with a maximum drawdown gone up slightly at 35%. If we take a look at the trades that are in here, we'll see that we're no longer only getting symbols at the start of the alphabet. Instead, it's prioritizing stocks which have the highest entry score as defined by the percentage change that we gave earlier. And as a result, we're getting some nice long runs of quite high percentage gains where it's catching a trend and staying with that trend for some time. One other thing that's worth noticing in these results is you'll notice the time in and the time out, and in both cases the trades are only taking place at the open, and that's the default for RealTest. But what we want to look at now is how we would change that and what would happen to the results if we do so. So at the moment in our RealTest script we've got an entry setup condition, and if that is met, a stock becomes eligible to be bought if it's a long position. And that will place a market order, and by default in RealTest that happens at the open. Now you can alternatively specify an entry setup plus an entry limit price, and if that happens, the entry setup gives you the condition for a stock to be considered, and the limit gives the price below which a long entry must be in order for the limit order to execute. So that can happen at 2 times. That can happen if the stock opens below the limit price, or it could happen if the low of the day is below the limit order price, and that happens intraday. Alternatively, we could pair entry setup with an entry stop command, and in which case that will place a stop order, and for this to execute for a long position, the open would have to gap up above the stop, and if it to be intraday, the high of the day would have to be above the stop order. Obviously reversed if it was a short setup. And finally, you can pair with entry setup an entry limit and an entry stop, and then if the entry setup is met, then you'll be triggered into this in a stop limit order if the price is between the stop and the limit order, again either at the open or intraday. Very importantly, only one of these entry orders is placed. So depending on which commands you specify in your script, RealTest will select which of these is applicable. Now let's look at exits, which are a little bit different. So at the moment we have an exit rule, and that condition decides whether one of our open positions is eligible to be sold. By default, that will be a market order which will happen at the open. We can also specify an exit limit price, and if there is an exit limit price specified, then there will be a limit order, and that will require price to be above a certain amount for the exit to take place. So that could either be when it opens, it could gap up, or intraday if the high is above that limit price for a long position. And we can also specify an exit stop, which places, no surprises there, a stop order, and again that will execute either at the open if the stock gaps down, or intraday if the low is below the stop price. Importantly, all 3 of these orders, exit rule, exit limit, exit stop, a market order, a limit order and a stop order, can coexist at the same time. And whether each one will be triggered will depend on the conditions, so they will be processed in order. Entry setup acts as a filter. For that condition needs to be met for either the market order, or if we've got a limit or stop price, for those kind of orders to actually execute. On the other hand, exits are different. Each exit rule, exit limit, exit stop, it's a separate order. Why are we doing it this way? Well, because RealTest is emulating what you actually do with a broker. With a broker, you'll typically only place one kind of order to get into a position. But you will quite easily have 3 different types of orders which are placed to actually exit it. Obviously, exit rule would only be triggered at a particular point. If it's true, it will automatically at that point execute a market order. But you could have a limit and a stop bracketing orders, a limit for if a long position, if you were trying to get out at a better price, so you've hit a limit that you actually want to take profits at, or a stop if you find that a price is dropping below your stop price and you just want out because the reason for being in that trade is no longer valid. So let's now try that in RealTest. This is a breakout system, so I'm going to add, after entry setup here, I'm going to add an entry stop, and I'm going to just make the entry stop the same as the previous close. So our condition now is that the entry setup, the close must be higher than the highest of the last 20 bars, and it must still be on the day of entry on the actual execution bar, we must still be above the close. We're going to be stopped in if we're above that. So let's try running that, and I'll run the test, and here we go. The results, actually it slightly reduces the rate of return, and the maximum drawdown has slightly increased. And if I right click this and show trade list, we'll see that now several of our entries are now intraday, meaning that the open didn't trigger them, but the high of the day was above the previous day's close, and others are at the open. But importantly, all of these are now stop entries. None of them are just standard market entries. They have to meet the stop criteria for them to happen. Now, that wasn't very successful, so I'm going to go back to my script and take out that line that we've just added. And instead we're going to add some different exits. So we've got an exit rule here of being below the lowest of the last 20 bars, but we're also going to add in an exit limit. And we're going to choose the fill price, the original price that we were in at, times 1.2, so 20% above the original fill price. And if we get to that, we'll be glad to exit and take profits. Let's test that and see how that performs. So now, because we've got two exits, we've got an exit rule and an exit limit, we can actually have two types of exit take place. We can have a market order if the close is below the lowest of the last 20 days, or we can have a limit order placed if the price goes above the fill price multiplied by 1.2, 20%. And you'll see that this significantly increases the rate of return, 27.3%, and actually decreases the drawdown. So just having that single exit condition has increased our results very nicely. Similarly, I could add a stop in here. So we would add exit stop, and this time we're going to also exit if we are below 10% of our fill price. And if we test this, we can now have the ability to exit on a market order, a limit order if we take profits at 20% above, or a stop order if we go below 10% of our original buy price. And this one actually reduces the rate of return, but it also cuts the drawdown down to a much more acceptable figure. We're getting quite good here. The rate of return is almost as good as the maximum drawdown. And if we right click that and show trade list, we'll see that we've got various different kinds of exits. We've got exit stops, exit limits, and the exit rule, which would just be a market order. And it's noted which ones were which. Now, what would happen if we want to actually exit at the close, or indeed enter at the close? There is a way of doing that. Let's take a look at how that works in RealTest. So far, the commands we've looked at in RealTest either place a market order at the open, or limits and stops, which can happen either at the open or intraday. If we want to change that, we're just going to ignore the limits and stops for now. We can change when market orders are placed, and we use two separate commands in RealTest. One is entry time at close, and the other for exits is exit time at close. Specifying either of these will move the time when the market orders are placed from the open to the close. However, note that it's not the close of the execution bar, it's the close of the previous bar, the setup bar, that is moved to. And this will only work if you have live data during the day and you can place an order just before the close. So as we get close to the close price, it's possible to see whether a condition is triggered. RealTest won't be able to do this because it relies on data from the previous day, but you'll be able to see whether a condition is met, and you could then place an order just before the close. So taking a look at our previous chart where we looked at entries and exits, this takes the market orders that are defined by entry setup and changes them from the open to the prior bar close. And similarly with exits, it takes the exit rule market order and changes that to a prior bar close. So let's do that now in RealTest and add the entry time as at close and rerun our test. And when we do that, we discover that actually we've reduced the rate of return and we've increased drawdown. So in this case, there's no advantage in opening a position at the end of the previous bar, the setup bar, rather than waiting until the open the next day. But it's a useful option to have. Many times this will be something that can increase returns. So it looks like we've developed quite a nice system here, particularly if we go back and remove that entry time at close statement that we just added, as it didn't help to add to results. But there's actually a slight problem with this, and to understand why, we need to revisit something we looked at in the tutorial video about importing data. So I'm going to switch this now from Yahoo to Norgate, and instead of using a fixed set of symbols, I'm going to use the S&P 500 current and past watch list. And as you may remember, that's a dynamic watch list that gets changed by Norgate as the constituents change. And we're going to save our data file as a slightly different name so we don't get them confused. And I'm also going to add in a constituency statement. I want to add in the SPX, which is the S&P 500. And then we can decide that we're going to, in our entry rule, only enter if the stock is currently in the SPX, in the S&P 500. So we're going to import our data, which closes the existing files that we have, and that's now going through an import of the 1,225 different symbols which existed in that just over 10-year period when this test is taking place. And now, having done that, we can run the test again. And now we can see that the rate of return has dropped significantly to just over 15%, and the maximum drawdown is pretty much the same. So why is that? It's because our previous tests used a static set of stocks which were in the S&P 500 at the time when we finished our test. But of course, those won't be the stocks that were in the S&P 500 over the entire 10 plus years of testing. In fact, the list will have changed quite a lot. And so we're actually dealing here with something called survivorship bias. And survivorship bias means that it's only the stocks that survived through to the end of the test that have made up our test. In this case, a breakout system, it turns out that that was very, very important, and that the system is actually much less effective once you take account through Norgate of which stocks are in an index and which stocks are actually surviving. In other words, looking at delisted stocks and the stocks that still exist now right the way through the test. So not quite as impressive as we thought, and a good example of why it's very important to include delisted stocks in the data that you're using to test. So I hope that's been a really useful overview of how the RealTest backtesting engine works. In the next few videos, we'll dive even deeper into developing strategies and the various other sections you can use. But for now, thanks for watching.